parallelly read volume 2 to enforce the ideas in volume 1. So volume 2 is like proof of volume 1. Okay everyone, let's start. Guys, we're starting the lecture now. Okay, Economic Survey volume 2. So like we discussed in our earlier lectures, Economic Survey has 2 volumes, as we know. There is volume 1 and there is volume 2. Volume 1 is highly conceptual in nature, in which a lot of ideas are discussed and they're connected to multiple ideas, and a lot of solutions are discussed. Whereas volume 2 is more factual in nature. You'll find more data here, and you'll get a lot of supporting arguments also here. So what volume 2 is actually meant to be is, volume 2 is supposed to be the supporting document for volume 1. So first we have to understand volume 1, then we have to suppose to parallelly read volume 2 to enforce the ideas in volume 1. So volume 2 is like proof of volume 1. Now earlier what used to happen is Economic Survey was typically the volume 2 format. This is the previous format. However, later it was decided that it has to be more accessible to the common man. So the one format was introduced. So one format is in simple language, easy language, whereas the 2 format is still in slightly more difficult language. So when you guys read, if you do read the Economic Survey, we have provided the highlighted PDF again. You will find that volume 1 is actually easy to read. It's even fun to read. But volume 2 will be more difficult to read. It will be full of numbers, full of figures, full of graphs, and the language also will be difficult language. So in volume 1 we had nice concepts like spreading, jam, and all those things going on. Volume 2 you won't find any such rhetorical language, interesting language you will not find. You will find very dull, normal kind of language. So what we are going to do is, most of volume 2 has already been covered. Even though we didn't separately say volume 2 chapters, etc., when we discussed volume 1 chapters, most of the chapters are already covered. So all the ideas which are there in volume 2 is already covered. So all the explanations required are also already covered. However, in prelims, we get some factual questions from economy. Those factual questions tend to come from volume 2. Conceptual questions and mains questions will come from volume 1. But volume 2 is where factual questions can come. So what we are going to look at is, we are going to look at some of those key points from where questions can come, and some key areas where volume 2 has given more description. We'll describe those parts as well. So this will be a more factual kind of lecture. So this will be more of a guidance oriented lecture. So let's start off. So first chapter we have already discussed in great detail along with first chapter in volume 1. So here we are only going to look at the overview. First comes the key ideas. If you guys remember, there is a lot of dependency on global growth. So there is C, I, G, NX if you remember, and the NX part is becoming more and more prominent because India is becoming more and more integrated. So we have a big dependency on global growth, and in the global scenario things are not looking good. Commodity prices are falling, slow growth is there, deflationary expectation is there, exchange rates are very volatile because of investor behaviors. Investors in general are not confident anymore. They're doing risk averse behavior. What is the meaning of risk averse behavior? Suppose you're invested in this area. Suppose risk increases in that area. What will you do? You'll immediately escape from the area. That is called risk averse behavior. So you tend to either stop investing or retract your investments. Now all this has also meant that exports have come down, imports have also come down, and the current account deficit has also come down. This is primarily because imports have come down more than exports, and here oil plays a big part. So all these key ideas we already covered in previous lectures. Now Indian growth, this is about global growth, but in spite of that, in spite of NX not performing, we are still growing. So overall GDP is still growing. So GDP is C plus I plus G plus NX. If NX is not helping it grow, then what is helping us grow? It is consumption driven. C is what is helping the Indian economy grow. However, economic survey goes into great detail about this, analyzes it, and comes to a conclusion that we need to have investment led growth path. So investment has to be the driver of growth, has to be the path through which we travel. So how to promote investment, again a lot of discussion we have done in volume 1. Now investment, when we come to investment, primarily most investments are routed through the banking or financial sector, and the banking sector is under a lot of stress. It is under stress because of NPA, because the corporate sector is having too much debt. So the twin balance sheet problem, all these things we discussed. Now words like twin balance sheet problem and all we will not find in volume 2, because that is rhetorical language, that is stylish language. All the stylish and easy language will be in volume 1. In volume 2 we'll have more discussion of how the financial sector is under stress, what kind of numbers are required to be known about that, all that is discussed here. So again, whichever is important we have highlighted and provided to you in the economic survey volume 2 PDF. So you have to browse through the volume 2 highlighted PDF and just pay attention to wherever it is highlighted. You don't have to by heart things, but pay attention once. This is called familiarity building. The moment you are familiar with some numbers, if same question comes in exam, better probability of getting the answer right. So do not try to by heart. You won't be able to by heart all these things, but read it 1 or 2 times, go through it 1 or 2 times, you will get a familiarity. Now box 1.1 covers the same discussion about consumption versus investment driven growth, and here you can say India should get back on an investment led path. So box 1.1 is a very important box, so it is advised that you guys actually read it. We have discussed this in detail again in the previous lectures. So some key points which are takeaways from this chapter, some things from where questions can come. India is the fastest growing major economy. Our growth rate is 7.6% growth. India's contribution to global growth. So if the world as a whole is growing, 14% of that growth is coming because of India's contribution. India's share in world GDP. The difference is should be understood. This is share in growth. This is share in income. So India's share in world GDP comes to be around 7% in PPP terms, in purchasing power parity terms. So in terms of normal GDP, it will be slightly lesser, but in PPP terms, India is 7% of the whole world's economy is India. However, it is consumption driven. So NX, I is lagging, and I another name is GCF, gross capital formation, that is also lagging. So it is lagging. This trend based questions also come a lot in economic questions in UPSC. So trends also you should be knowing. What is increasing, what is decreasing. For example, you can see here in agriculture, growth is lower than what has been going on. Last 2 years has been bad. In services, it has been robust growth. However, it is not as high as what we would like it to be. In manufacturing, the growth is increasing, so accelerating. These kind of trends you should be aware of, and these are things you should by heart. Whatever we are providing in these notes, you should by heart. But whatever is in the economic survey highlighted, at least go through once and at least try to be familiar with those things. Second important part of this chapter. Chapter 1 is basically all the chapters ka introduction. So everything that is covered later is again covered in chapter 1. So that is how they plan the economic survey. Same for volume 1 also. So second part of the chapter which is important to us is public finance. In public finance, there are 2 things going on: fiscal federalism. This is the relation between center and state, and fiscal consolidation. Consolidation means the center is trying to reduce expenditure and increase revenue. That is consolidation. So that is also going on. Now, what is the outcome of that? The economic survey says 3.9% fiscal deficit we can easily manage. And 15.8% increase in tax revenue is also estimated. So 15.8% increase in tax revenue is what is expected or desired by the economic survey. Again, the exact number is not required, but you should be knowing it's somewhere around 15%. Now, monetary policy, again, inflation is okay, which means economic survey recommends an expansionary stance, which means we should increase the liquidity in the market, increase the money supply in the market, so that interest rates can come down, investment can increase, the entire chain of things. So CPI, the consumer price index, is inside the target. Now what is the target? For plus or minus 2. So it is within the targets. It is neither above nor below. So CPI is safe. WPI, The wholesale price index has been negative, in the negative territory, so slight cause for concern there. Liquidity conditions, economic survey says, can be looser, so again trend based. Bank credit growth. The credit growth in bank is very important because investments will come from credit. So savings become credit through banks, and that credit is what allows investments, which generates profits from which savings again can come. So credit is an important component there, and credit growth is not happening properly. So that is another problem, and this happens because of a concept we already discussed called inadequate monetary policy pass through. So we have discussed this in detail in previous chapters, along with NPAs, low investment, low confidence by investors. All these things together is causing one part of the problem in monetary policy. So fixing the banks is another big thing we have discussed in the last 3 lectures. So again, some more key points. The next important part of the chapter is trade policy. So what is happening for India? There are merchandise trade. Merchandise means goods is declining. So what kind of corrective measures can we take? How can we boost up our trade? For that, new foreign trade policy, which is a 5-year policy from 2015 to 2020, has been implemented. It is supposed to support both manufacturing as well as services. The WTO 10th Ministerial Conference in Nairobi happened. As we have seen, we have gone through the issues already, and there is also a separate video provided for you guys. It is available if you search Byju's classes WTO video, you'll get it. So here, least developed countries has a lot of issues, primarily about having access to market, having technology. All those issues are discussed. Inside agriculture, which is the area where India was primarily interested, we have special safeguard mechanisms, which we have discussed. Public stockholding, which is about being able to provide food security to our people. Abolishing export subsidies right now by developed countries, by 2018 by developing countries. So these 3 components we discussed in detail earlier. So special safeguard mechanism, if you remember, economic survey says, is it even required, or do we need both SSM as well as high ceiling rates for tariff lines? Public stockholding, do we want to do that? Why don't we transition to DBT? And export subsidies, again, it's a questionable thing. Is will India be able to promote a export oriented agriculture without export subsidies? And trade facilitation agreement was what the developed countries were primarily interested in. India used that as leverage to be able to get the public stockholding that we wanted. So developed countries wanted TFA, India wanted public stockholding. We said, unless you give us public stockholding, you will not get TFA, and they had to agree. So overall, in the external sector, as far as India's outlook is concerned, things are fine, but the global economy is in a proper doldrum situation. So low current account deficit, FDI inflow is robust. Robust means good. NRI deposits are also robust. Reserves are robust. So robust, when you say the word in economics, it means no cause for concern. So it's like saying this person is healthy. So robust FDI means healthy FDI. So that language you can use. External debt is at 1.7%, which is again safe. So no cause for concern in these areas. In tourism, which is an important area for India, there some problem is happening. The growth is coming down. FTA is tourist arrival, foreign tourist arrivals, and FEE is foreign exchange earnings. So how many tourists are coming to into the country and how much money they're spending in the country and foreign exchange we get from them, these things are coming down. So cause for concern there. Also the whole Chinese thing that we discussed earlier, Chinese adjustment is going on, currency adjustment might happen, currency war might happen, Chinese economy might slow down. All this will have repercussions on India as well. So those areas are again here in this volume not much discussed, but we should touch back to the previous volume also, because it has to be read in parallel. It has to be understood in parallel. As you can already see, all the ideas are parallel to what we saw in volume 1. Then the rest of the chapter 1 we will cover in respective chapters. So we have a chapter on climate change, on the different sectors, service sector, industry, infrastructure, human development, poverty, etc. We'll be covering in the respective chapters in this particular lecture itself. So let's move into the second chapter, which is public finance. So again, some key points from the chapter. First thing, as we discussed earlier, it's about fiscal consolidation. We are trying to consolidate our expenses, which means we are trying to consolidate our fiscal deficit. So reducing expenditure, increasing revenue is our target. And we don't want to spend too much. So G is going to be not neutral when it comes to C plus, I plus, G plus and X, which is why C is currently driving. We have to move towards I, as we discussed earlier. So India's contribution to global growth is 14%, as we saw earlier. However, we require fiscal consolidation and we have some tax reforms that are required here. So here there are two important boxes, box 2.1 and box 2.2. Okay, so there we'll quickly go over to the boxes and just quickly see the box once. So you can go to box 2.1, directly click here. It is page number 3 here. So if you scroll down, we can see all the indirect tax measures being mentioned there. You can see customs, what is happening with customs. So as we mentioned here, please read the whole box once. Don't try to by heart. Just know where all these things are there. For example, dye-in rubber is there, water blocking tape is there, mica glass tape is there, fertilizer is mentioned, anthraquinone is mentioned. Now, what UPSC has done in previous years is that, suppose mica glass tape is mentioned here, a question might come about the use of mica glass tape. So there is a reason why we are allowing incentive to them, right? Mica glass tape is important for your country. That is why we are giving some protection for them, or we are giving some boost for them. So question can come in UPSC, which of the following is the use for mica glass tape? And there the answer is for use in manufacture of insulated wires and cables. So that way questions will come from here. Direct question won't come. Reduction in customs happen for which of the following? That chances are less. However, in any of these things mentioned here, a question can come about LCD and LED difference. And similarly, questions can come about naphtha, ethylene dichloride, any of these areas questions can come. So this entire box, read through once. Don't try to by heart, just read through once and you'll have familiarity enough to tackle it. Now let's go to box 2.2, which is in page 7. Here direct tax measures are mentioned. So again, some important schemes are mentioned here. So you should be reading through it once. So this is how you'll tackle the boxes. So let's get back to the lecture now. Now, there is also a discussion on quality of expenditure, like we discussed earlier. Of course, we are going to bring down our expenses, but even if we reduce the money we spend, the quality of money we spend, we want to increase. And how do we do that? Invest in health, education, infrastructure. There's also a 3-4 pages long discussion in economic survey about plan versus non-plan discussion. The highlighted areas you should go through once. So that is one extra work you have to do. We are not mentioning it here. Direct questions are not expected. However, because of the planning commission versus Niti Aayog situation, planning commission was stopped and Niti Aayog was created, we can have a question about plan and non-plan. So a question can be as simple and conceptual as which among the following can be classified as a plan expenditure, which among the following can be classified as a non-plan expenditure. In the last 3 years, plan versus non-plan, which was the bigger component of expenditure? That kind of questions can come. So familiarity is again useful. Reducing subsidies, we have talked a lot about that in previous lectures. Here again, box 2.3 introduces the idea again. So overall, as we discussed, deficit is going to be 3.9%, out of which, so government has deficit of 3.9%. Deficit means what? It means debt only, right? So how is the government getting this money? It is primarily domestic financing. So 98% of our deficit is domestically financed, which means we are able to generate it within India itself. That is good news. And even that is primarily market based. So Indian government is having deficit, which we are raising from our own domestic market. So that is a very positive sign. Now there's a concept called general government. So when we normally say government, we talk about the central government. However, general government, when the exact phrase is used, it means states plus center. So when I say general government budget, that will mean states expenditure plus center expenditure, state revenue plus center revenue, general government expenses, states plus center, general government deficit, again state deficit plus center deficit. So if you calculate all the states deficits also, only central government is 3.9% deficit. When you bring in states also, the fiscal deficit becomes 6.3%. So fiscal deficit of general government is 6.3%. That is required to be understood. Then as we saw earlier, pay commission has recommended increase in pay rise. So that will cause increase in C, increase in government spending. One rank, one pension has been implemented. That again causes increase in government spending. So all this causes increasing pressure. Pressure towards what? Pressure to pressure that will make it harder to fiscally consolidate the budget. Now public investment, there's a lack of private investment. I is not there. So economic survey recommends instead let government investment take up that slack. However, it will be expenditure switching. Instead of spending on something else, we'll spend on more quality expenditure, because we want to maintain the FD at 3.9%. In spite of these things, we still have to maintain a 3.9%, and as we saw earlier, 15.8% growth in tax revenues desired. Cooperative federalism, again here if you remember, we had a phrase, good economics is also good politics, and that is cause for optimism. So different states will be competing to get more investment. They will compete with each other to improve the ease of doing business in their own areas, and that is called competitive federalism, in which two states compete in a very positive manner. Now with greater devolution post the 14th Finance Commission, the economic survey says competitive federalism has even more importance. Why? Because centers, more money is going to states, so center won't be able to do as much, so states has to do more. And why would states do more? Because they're competing. So competitive as well as cooperative federalism is required. So slight mistake here, I was talking about competitive federalism, whereas here cooperative federalism is written. So yes, so more greater devolution means more cooperative federalism is required. Along with that, we'll also have competitive federalism, which will make sure that overall business environment also improves. So states' responsibility increases because of this greater devolution. Now a few figures. You can see trend in fiscal deficit. Now this trend is very, very important. Just know 2012 it was around 4.9. Now we are reached 3.9. In general, we have been meeting our targets. So that is fiscal deficit, FD. Then we have revenue deficit, right? Which is only the revenue part of the budget. The revenue expenditure and the revenue receipts. So there 3.7 to 2.8 it has come down. Please remember these numbers. And finally we have primary deficit also, which is 0.7 now. So these numbers you have to remember, these three numbers, as well as the fact that everything is declining. So throughout the trend is declining. Now this is a very positive outcome, right? This positive outcome has happened because of few things. One is tax buoyancy is there. So tax buoyancy means as the GDP is growing, the tax collection is also increasing. So buoyancy, right? You put a ball in water, the ball comes up. Similarly, the tax is coming up. Expenditure management by government. Economic survey is praising the government itself, has been prudent, which means proper. Declining oil prices have helped a lot. Decline in the major subsidies, which the government has pushed hard for, has also helped. And more tax devolution is also part of this discussion. And we have been spending more on capital expenditure, which is also a positive outcome. So again, some numbers here. So in the internal debt of the government, external debt of the government, and the total debt of the government, it is good to know. So you can see the numbers here. Again, don't try to by heart any of these numbers. Just glance through one or two times and just get to have a familiarity with it. So what is budget estimate B? There is budget estimate, there is revised estimate, there is advanced estimate. These terminologies are used when discussing the budget. So in the budget discussion, we'll introduce those concepts. And anybody who's familiar with the basics should be knowing these figures, these terminologies anyway. So that is about chapter 2. Now we move on to chapter 3, which is the monetary policy. So chapter 1 is an introduction. Chapter 2 is fiscal policy. Chapter 3 is monetary policy. So again, some key points for us in this particular chapter. So lowering inflation is equal to easing of monetary policy, the same repetition of the concept. However, some numbers inside that where questions can come. From Jan to September 2015, 125 basis points cut. What you have to do is, before you enter the exam hall, just see, before you enter the exam, one day before, just see how many basis points cut was there between Jan and that particular day. For example, you have to consider Jan to August 2016, how many basis points cuts were there. So economic survey is talking about 2015. We have to update ourselves. So before the exam, you find out this and just keep it in mind. So again, pay commission or OROP will increase pressure. So this WACR is weighted average call rate. So what is call rate? It is what happens in the call money market. So call money market is a good indicator of the liquidity condition of the country. So when call money rate is very cheap, that means money is easily available. That means liquidity is high. Right now, Economic survey says WACR, weighted average call rate, is above the repo rate. When weighted average call rate is above repo rate, that means it is easier to get money from RBI than from the call money, call money market. That means liquidity is constrained, liquidity is tight. So this is important. We have been talking about liquidity being tight. Here economic survey gives us the proof of why they consider liquidity to be tight. WACR is above repo. So again, monetary policy pass through, it is because of structural rigidities. Some things are happening. So we have competition by small saving schemes. The public sector bank rates has not changed much, and base rates are determined by average cost of funds and not on marginal cost of funds. So this is something RBI has addressed going forward. So in the current affairs lecture also you would have heard about this. So what RBI has now done is base rate, which is the rate at which bank will lend to you. They have a formula for calculating it. So in that formula, an important component is the cost of funds. So based on cost only you can decide the price, right? Based on cost price only you can decide selling price. So cost of funds, how you calculate is very important. If you take average cost, then over a long period of time the cost will remain pretty much the same. But if you take marginal cost, it has to keep changing. Now the difference between average and marginal is average is of the whole thing, marginal is of the last unit. So the last rupee, how much did it cost you? What is the cost of getting 1 rupee? Is it 5 paise? Is it 10 paise? Is it 20 paise? Based on that you have to decide your base rate. Then the base rate will become more responsive to monetary policy changes. So that is what RBI has tried to do later. So economic survey talked about it, RBI later implemented it also. The global financial market, which I have short formed as GFC, is volatile and there is concern about China. So RBI is also concerned about China because RBI will have to respond to any monetary mismanagement by China. And banking credit, as we saw earlier, is sluggish and their asset quality is bad. Asset quality is bad. What is the asset for a bank? Asset is money or something that will generate money. So asset for a bank, if I give a loan to you, then it's an asset for me. That loan is an asset for me because I own it. I will be getting it back. So for a bank, any loan given out is an asset, whereas any deposit taken by the bank is a liability because the bank has to repay that money. Now assets are loans, right? What if that loan is not coming back or the person is not able to repay the loan? Then we can call that asset a non-performing asset or a bad asset or a loss asset, etc. So asset quality means what is chance of the money coming back. So here in India, in a lot of banks, asset quality is deteriorating, which means less and less probability of getting it back. And on the other side, on the corporate side, there is growing indebtedness. They are becoming more and more in debt. So here loans are growing, their debt is growing, and that is called the twin balance sheet challenge. Both the bank's balance sheet and the firm's balance sheet are under pressure. The TBS challenge is not there in volume 2 as I mentioned earlier, it is there in volume 1, which we discussed in detail. Now, so banks are having problem, right? Banks' asset quality is bad, the firms are having too much debt, they don't want to take loan, and that is the reason why bank is not giving out loan. So when bank doesn't give out loan, credit growth comes down. Now another problem that is hitting the banks is that deposits are also not coming in now. Time deposits, which means long-term deposits, is also not growing. So that's an important source of bank funding. Banks, if they get a lot of long-term funds, then they can use that to give short-term loans and get more money. But time deposits are also slowing down now. Capital market is okay. And the public banks are also subdued. So some trends here. This is the time deposit rate. So you can see time deposit rate is coming down here. And the credit outstanding is the red line here, again coming down. Demand deposit part seems to be okay. So time deposit has come down, demand deposit has increased. So the long-term assets have come down, short-term assets have increased. But you can't use short-term assets for short-term loans. That becomes problematic. So bank somehow has to increase the time deposit part of it. Now if you look at the bank credit outstanding, which means credit is yet to be taken back. So again you can see bank credit is coming down. So two trends here. Term deposits coming down, bank credit is also coming down. Asset quality is deteriorating, indebtedness of corporate sector is increasing. So again, don't try to by heart the exact numbers, but try to have an approximate idea of where the figures stand. So why is this decline happening? Incomplete monetary transmission. RBI reduces interest rate, but interest rate is not being reduced by banks, which means people are not taking loans, so credit comes down. Banks are also not willing very much. They don't want to give it out. Corporate balance sheet is also very bad situation. They don't want to take on more loans. And borrowers are now interested in investing in bond market. They get higher interest rates there. So they are moving to bond market instead of the credit market or the loan market. So all some of reasons why credit growth is slowing down. So again, this can be a potential question. Now in different sectors, how is the credit going? So you look at 2015, you can see agriculture is 17.7, industry got 25.4%, services got 22.8, 22.8%. Personal loan seems to be dominating the sector with 34.2% growth. That means again it is consumption driven, because personal loans goes where? Consumption. Industry loans and agriculture loans might go into I, but those are comparatively shorter. So you can see here 31.5% became 25.4, 43.4 has now become 25.4, and here also 22.6 has become 17.7. So investment oriented credit is coming down. Consumption oriented credit has actually kept on increasing, 15.3, 18.1, 20, 29.7, 35.2. So consumption is what is being fueled by credit. So credit is what is fueling consumption. Now about liquidity conditions, some more detail, some factual data about it. Gross NPAs, which is the non-performing assets in the country, has increased to 5.1%. Of the total loans given out by banks, 5.1% are NPA, classified as NPA. Inside that, there's a category of stressed assets, which means repayment is not regular, etc. Those are also 14%. So stressed is 14%, NPA is 5.1%. Potentially useful numbers to remember. Now, banks require 1,80,000 crore of capital infusion, so that is required. So government has announced that 70,000 of this it will give in this year, and the rest will be given in subsequent budgets. Now why do they need this? This is for something called capital adequacy ratio under the Basel norms. To be able to match the Basel norms or prudential norms, they should have this much capital. So government only is providing it. This is primarily for public sector banks. So what is capital adequacy ratio, etc., we will not get into here. So please read NCERT or refer to the tablet. So some important reforms and policies introduced by the government in the financial sector. A Mudra bank has been introduced. It's supposed to regulate all microfinance institutions. Microfinance means small lending. A 20,000 crore corpus has been founded. And it will last mile credit delivery to micro businesses will be conducted. And Pradhan Mantri Mudra Yojana is the full name. So a lot of people will be benefited by it. So some couple of things here might come as questions, but in general you should be aware about the Mudra Bank and the Pradhan Mantri Mudra Yojana. Another scheme. So just some more elaboration about this scheme itself before we move to the next one. So what is the purpose? The non-corporate small business sector, they also need credits, right? Providing credit will be through Mudra. So typically it has to be non-farm income, enterprises, manufacturing, etc. Then it will be eligible. So there will be different types of offerings. There will be Shishu, Kishore, Tarun, depending on at what stage in the growth of the business we are providing. So Shishu will be for very, very small businesses, just starting micro unit. There you will give a Shishu loan. Once it has grown a bit, it has become youth, then you will give a Kishore loan, etc., etc. So again, you have to categorize and then approach and then get the loan. So Shishu is up to 50,000, Kishore is up to 5 lakh, Tarun is up to 10 lakh. So this classification, please remember. So names and the classification, please try to remember. Then we have Pradhan Mantri Jeevan Jyoti Bima Yojana. So people who are familiar with Hindi, they will easily be able to decipher the entire meaning from the name itself. However, the idea is to give a life insurance plan. So here full details are there. 2 lakh, 330 rupees per annum only is the premium. All bank account holders can avail it. It's offered by LIC, etc. So 2 lakh benefit will be given to the nominee on the death of the person. So some figures here. Please try to remember how much is the sum assured. There's an assured sum here with a very low premium. That is what is crucial about this particular yojana or scheme. Then we have Pradhan Mantri Suraksha Bima Yojana. This is about accident. The previous is life insurance. This is accidental insurance. Again, the number is 2 lakhs. and the premium is very low, 12 rupees per annum only. So these figures are also useful to remember. Then there's the adult pension yojana. So first one is about life. So on death, what happens? Second is about accident. If you have an accident, what happens? Third is about pension. After your job is over, then how do you take care of yourself? So again, a fixed pension will be provided, 1,000 rupees to 5,000 rupees. And again, contribution depends on age. So the more your age, less your contribution will be. The less your age, more your contribution will be, depending on how much pension you want. And government will contribute 50% or rupees 1,000, whichever is lower, for 5 years only. So here money cannot be taken out typically unless it's exceptional circumstance. The money will stay in because we want to force people to use this money after they are retired, not before that. Now we come to the next chapter, but before that let's take a very short break of around 2 minutes. Stay tuned. Any doubts, please ask. Okay everyone, welcome back. We're starting with external sector chapter 4 now. So again, we'll have some key points from the chapter first before moving into some more elaborate discussions on the chapter. So again, here this entire chapter is primarily full repetition from volume 1, and we have covered this chapter already, but here we'll again highlight some key points. Okay, so there's a full CAD discussion. The current account deficit is okay, external debt is okay. Foreign investment, we will see. This discussion is slightly important. This part we will see separately again. So box 4.1 is a useful box. The foreign trade policy of 2015 to 2020. Very important box. So you have to go through it. And box 4.2 gives you trade facilitation measures adopted by the Indian government. Again, very important. So some areas of it will be showing you. The WTO Nairobi negotiation details, also important. We have discussed it. So these are the highlights again. LDC, SSM, food stock holding, export subsidies. And there's also the regional trade agreement discussion. So we have box 4.3 coming in here. The implications of TPP for India, box 4.4, these areas are important. So again, everything important is highlighted and provided to you. However, it's all repetition of things in volume 1. So there are no key ideas which is coming in again here, and the figures here, questions won't come. When the questions that do come will be too difficult. However, go through it once, read through the figures once. So we'll be highlighting some most important figures here in the lecture itself. In external debt, what steps are required by India? That is also covered in this particular chapter. So if you look at the BOP situation in the country, in spite of merchandise trade coming down, in spite of my exports coming down, BOP has remained stable, and that is primarily because imports have also come down even more. And trade deficit of the country, which is the merchandise trade deficit or the trade in goods, has come down. So last year it was 74 billion. This year it has come down to 71 billion. So this is something useful to remember, because this kind of trend based questions have been asked before also. So trade deficit has come down from 74 billion to 71 billion. Now some key features are observed in the BOP situation. There has been a net outflow of FPI. Please remember this. Foreign portfolio investment, which is very similar to the foreign institutional investment, what you guys know as the FII, but FII terminology is not proper now. We have to use the terminology of FPI, has been outflow, whereas FDI has been inflow. NRI deposit has been inflow. So these two are inflow, this is an outflow. Please remember that. Foreign exchange reserves had gone beyond 351 billion. Now in FPI reforms, some points. First thing is that there are some limits to be announced. In FPI, some limits will be announced and has been announced. On government security, when a foreign investor comes as an institutional investor or a FPI and starts investing, the limit is 5%. So 5% of government securities can be invested in. Beyond that, nobody is allowed to invest. This was less than that earlier. Now it has been increased to 5%. So limit on government security has been increased to 5%. Another factual detail to remember. And overall FPI investment in any central government security will be 20%. The limit will be 20%. So individual government securities 5% limit, overall government security limit 20% limit. So these numbers has to be remembered. So this actually means that the cap has been increased. Now imagine earlier cap was 2% or whatever the percent is, and at that point only 100 rupees used to come in. The moment you increase the cap, more people can invest. That means more money will come in. Like that, 1,200 billion extra money is supposed to come into central government securities because of this relaxation. That means government will be able to raise more money. So current limit was 1,535 billion. So on top of that, an extra 1,200 billion has been added. So government has a scope for raising more money through this FPI reform. Now the external commercial borrowing. So here we're talking about sovereign debt. Government is borrowing. External commercial borrowing. Who's borrowing? Commercial enterprises. Private sector is borrowing. Has been classified into 3 categories. That is again a reform. Medium term, long term, both foreign currency denominated, and Indian rupee denominated ECB. Now what is the meaning of foreign currency denominated ECB and Indian rupee denominated ECB? Foreign currency denominated ECB means you have taken a loan of $10, you have to give back $10. It doesn't matter what the exchange rate is. So if $10 you take and exchange rate is 50 rupees, in rupee terms how much do you have to give out? You have to give out 500 rupees. However, the $10 has to go out. Now later on, this becomes 100 rupees. Exchange rate becomes 100 rupees. Same $10 you have to still give. However, now you have to give 1,000 rupees to make it $10. This is the meaning of a foreign currency denominated ECB. And when it's foreign currency denominated, when the foreign exchange value fluctuates, the value of the loan also fluctuates. If it's Indian rupee denominated, we have taken 500 rupee worth of loan, we have to give back 500 rupee worth only. So there we are immune from shocks in the foreign exchange rate. So this is a safer category, and among these two, medium term, long term is better, medium term is more risky for us. So if you look at India's foreign trade, you can see the imports have come down drastically, exports have also come down drastically. That is why CAD has moderated, as we discussed earlier. So again, numbers slightly important. Please have a look at these numbers. Even 2014 was still negative category, but it has gone much into negative category now. In 2013, if you can see, 13-14, the exports actually became positive category. So some of these trend based ideas we should be keeping in mind. And the only reason we are showing you this pictorial representation is, even if you don't by heart, because you look at the picture, you might be able to recollect a bit. That's the idea of having pictorial representation. So you can see here trade deficit continuously coming down. This is the trade deficit continuously coming down. And inside trade deficit, the biggest categories inside trade deficit is the POL deficit, which is the oil-based trade deficit, and the gems and jewelry deficit. Again, we are big importers of gold, so gems and jewelry also causes a lot of deficit for us, which is why we have the whole discussion of how to reduce gold import, etc. So these are two big categories, and you can see here, if you look at the gold part, not much change, pretty much same. But if you look at this part, big change, and that is one of the reasons why CAD is coming down drastically, or trade deficit is coming down drastically. So again, don't need to by heart the numbers, but please be aware of trend. POL deficit is coming down consistently over the last few years, whereas here you can see that actually increased a bit, and that is why overall trade deficit also increased. So our trade deficit is highly dependent on our POL deficit, or in general that in turn is dependent on oil prices. Now the FTP 2015 to 20 we discussed about some salient features. 900 billion of export of goods and services. So 900 billion exports is the target under the FTP. India should have 3.5% share in the world exports. 11.5 growth in annual export. These are the targets. So we have two reward schemes you have seen earlier. One is for merchandise export, one second is for service exports. So every existing export reward scheme will be merged into either one of these two schemes. For SCZ exports, etc., will be giving higher rewards under MEIS, and this will boost further. Credit scripts will be given, which is basically input credit, and they'll be freely transferable. You can use the input credit to in customs duty, in excise duty, service tax, etc. So how it will work is like this. Suppose you're supposed to pay a service tax of 10 lakhs. 10 lakh service tax is pending for your company. However, you have also exported something worth 5 lakhs and earned foreign exchange for the country. So you will get a import credit of 5 lakhs. And you're supposed to pay service tax of 10 lakhs here. Now, because your import credit script is freely transferable, that credit script or credit script of 5 lakh can be used for paying the 10 lakhs ka 5 lakh in the service tax. So out of 10 lakh service tax, you'll actually only pay 5 lakhs because 5 lakhs you have import credit. So that credit you can use. So it's like saying that, you helped somebody. Because of that you got some credit. Now you can use that to buy things that you want or pay off your debt, etc. So export obligation will be introduced, and it will be aligned towards Make in India, Digital India, Skill India schemes, which is again important. And states also should have a contribution, and in the middle of the year we'll have a review. So 5-year policy, 2.5-year review will be there. So this is some of the characteristics of FTP. The Nairobi package. So this is again something we have discussed in great detail. Only the summary is here. This is primarily for notes purpose we are providing this. So public stock holding, special safeguard mechanism, export subsidy abolishing, some cotton related measures, and preferential treatment to LDCs. So this is the Nairobi package. So if you have to write a quick summary of Nairobi package, all points should be included. At least these points should be included. The Trans-Pacific Partnership Proposal, or the Trans-Pacific Partnership, the TPP. There are multiple these kinds of people. There is APEC, Asia Pacific. There is Asian, Southeast Asian countries. There is NAFTA, North American Free Trade Agreement. There is TPP, Trans-Pacific Partnership, and there is the EU Economic Union, European Union. So all those guys are highlighted here. In the green, we have EU here. In the yellow, we have APEC here. In the blue lines, we have Asian, which is here, etc. And in the yellow lines, we have NAFTA. And when you combine all these guys together, we get the TPP. And you can see the TPP countries here. All the TPP countries are listed here. And a question can easily come: which among the following is not a TPP country? So that kind of question can easily come. So which among the following is not APEC, which among the following is not Asian, which among the following is not NAFTA? All these kind of questions are possible. So you should be familiar with these groupings. Now if you look at India's external debt, again some numbers here, no need to by heart any of these things. Look at long-term debt, look at short-term debt. You can see long-term debt is 82% of the total external debt. Short-term debt is very small, and this is how it should be. Short-term debt should be small, long-term debt should be high. So inside that you can see multilateral is 11%, bilateral is 4.5%. From IMF our debt is 1.2% of our total debt. Our commercial borrowings are a big chunk. 37.7% of India's total external debt is coming from commercial borrowing. Another big chunk is NRI deposit. So you can see these are two big areas, and the next big area is multilateral debt. So again, these things you should be aware about, which are the big areas, approximately where they stand, etc. So some debt indicators. So external debt close to 500 billion. The ratio to GDP usually close to 20 to 25%. Debt service ratio is how much money is required to service or pay interest on the debt. So 7.5% is going towards debt service only. Foreign exchange reserves to total external debt. So how much of our total external debt can be covered by a foreign exchange reserve? 72.5% of our total external debt can be covered by a foreign exchange reserve. So that is a very good percentage again. However, inside that, short term is what we usually have to cover very fast. So 24. So short term debt to foreign exchange reserve, our short term debt is only 1/4 of a foreign exchange reserve. Or in other words, a foreign exchange reserve, forex reserve, is 4 times a short term debt. So no cause for concern there. So other figures we have already seen. So those are the important parts about the external sector. Now we move into another important chapter, which is chapter 5, agriculture and food management. This chapter also has a discussion about prices and inflation. So the full name of chapter is prices, agriculture and food management. However, we are going to highlight these two areas in this particular discussion. So key points for us, again, lowering inflation, the price part of it, and easing of MP. But inside inflation, pulses have spiked. So overall inflation is low, but pulses inflation has increased, protein inflation has increased, and between WP and CPI there is a big wedge. Wedge means too much difference. There is a wedge between two friends, because means their friendship is not good anymore. Similarly, WP and CPI, there is too much difference between them. So WP has become negative, CPI is still moderate. So this growing wedge is happening because CPI is driven by food and fuel, because they are big components of CPI. So this shows that these two guys are driving inflation, or these two guys are causing the biggest changes in inflation. Now agricultural growth is slowing down. So that's a big problem. Need for transformation in agriculture. So we have already gone through some of the key ideas here. Let's look at some of the key figures here. 4% growth target was kept for agriculture. If India is to grow at 8%, agriculture has to grow at 4%. Please remember that. Productivity challenge we have seen. So irrigation technology is very important for us. 60% of the country is rainfall dependent. So whenever we have bad monsoon, we also have bad agriculture. So that is why we have to move towards more crop per drop. Water conservation, water management has to be proper. So IPU, irrigation potential utilized for the country, is very low. Even the irrigation that we have also we are not using properly. That is why we have to move towards more crop per drop. So multiple programs have been oriented towards it. So MG Narega, we want to use it to make our irrigation and our canals proper. Pradhan Mantri Krishi Sinchai Yojana we want to use to improve our irrigation. Micro irrigation, drip irrigation, these technologies we want to be able to use. Again, we have discussed the details of those technologies in the previous lectures. Now, efficient use of inputs is another crucial part of agriculture. So just like more crop per drop, the idea is now we should get more for less, like we discussed in volume 1. More for less is required. More for less everywhere. Seeds, fertilizer, water, pesticides, credit, extension service, everywhere you should be able to put less and get more. That's how productivity will increase. And everything should happen in an input, crop and region neutral way. What is the meaning of that? The things that we do should not distort things. It should not mean that because we are promoting something, more of urea is used. That should not happen. That's an input neutral method. Crop neutral means because we're promoting one type of crop should not become overly utilized. That is crop neutral. And region neutral means because of a measure, some parts should not become overdeveloped, some parts should not stay underdeveloped. That is region neutral. So do not cause distortions. Input crop and region neutral way, important language to use. And we have to introduce a DBT in the public distribution system also for all inputs. Only then we will be able to do this in a proper manner. This chapter also tackles some allied sectors, agriculture and allied sectors, horticulture, dairy, livestock, etc. Some of these areas are touched upon. Now in agri marketing part, discussion is about a national agricultural market or a one market for agriculture. This we have covered earlier. Trade policy again is discussed. WTO again is discussed. Here again special safeguard mechanism, food stock holding. Okay, so first CPI and WPI, just a trend based figure. You can see the big wedge here. CPI is all the way down here. Sorry, WPI is all the way down here. CPI is all the way up here. Still moderate, but there's a wedge between them. Now if you look at the composition of these two guys, you can see manufactured product is 65% of WPI. Fuel and power is only 15%. Primary articles and all is 20%, and food hardly even figures in the wholesale price index. So it's a much smaller component. Whereas in consumer price index, if you see, 46% is food and beverages. So food increases, CPI will immediately increase, right? But WPI won't increase. And another big component here is fuel, 6.84. But in WPI, fuel is much higher. So oil prices fall, CPI will fall, but not as much as WPI. WPI will fall more because fuel and power is a bigger component of WPI than of CPI. So it will fall more. So this split is required for us to understand. Only then we will be able to understand why WPI and CPI is behaving in these manners. Okay. Now if you look at agriculture and employment, close to 50% of the people of the country depend on agriculture to be working. So the employment depends on agriculture. Whereas contribution or income from agriculture is only 17.4% of the whole GDP. This means that actually 50% of the employed people are living on only 20% of the national income. So there's also inequality debate to be discussed here. Now if you see the last few years trend growth in agriculture, 2012-13 1.5, 2013-14 good year 4.2, but since then 2 bad years. So in the last 4 years we had 3 bad years and 1 good year. In fact, this can be told to be an okay year. This is a good year, 2 bad years. So last 2 years has been bad years for us. However, target is still 4%, and it's not unachievable because we have achieved it before in 2013-14. 12 5-year plan envisaged 4%. So in the 12 5-year plan period, only 1 year we were able to achieve the 4% growth. Now what is the reason for this lower growth? 66% of cultivable land is dependent on monsoon, which means irrigation is not being provided. 2 successive failures of monsoon, 2 years in a row because of El Nino, we haven't had proper monsoon. Irrigation is not expanded enough, it's not efficient enough, and market prices keep fluctuating, so farmers are always unsure about what to cultivate, how much to cultivate, etc. And cropping patterns are getting distorted via government policies like MSP. So more cereals are being cultivated, things that are less useful for the particular area like sugarcane, which is a water hogging crop. All these distortions are being introduced by government policy. So these are some of the reasons for lower growth in agriculture. Now the biggest reason why whatever growth in agriculture that does happen in India primarily happens because we expand the area under cultivation, but we cannot indefinitely keep on expanding area under cultivation. So in our previous lectures we had seen that there's a competition with agriculture with manufacturing and other industries, because they also want land now. Everybody wants land, every industry, every sector wants land. So if agriculture is not a high productivity sector or a high yielding sector, we cannot allocate so much land to agriculture. Again, the concept of more from less. So we have to be able to use the land available to produce more, or crop yield or productivity has to increase. So you can see India is very less compared to China, Compared to US again very less, compared to Canada less, compared to Brazil less, compared to Bangladesh less. Australia is an outlier here because the country itself is much more difficult to cultivate kind of country. However, India has a lot of scope for improvement. We can easily at least reach China's level, or even if we reach Brazil's level, there's still a lot of scope for improvement. So productivity growth is one crucial area of discussion. So how do we increase? First, more irrigation please. Second, proper use of water please, and don't allow wastage of water. Seed development, R&D, better varieties of seeds, more indigenous oriented varieties of seeds which is suited for Indian climatic conditions. Mechanization of agriculture, and maybe even addressing concerns about GM crops, because GM crops can allow higher yields, lower wastage, more resistance. All those advantages come in. There are disadvantages also. Those discussions are part of a science and technology discussion. Say efficiently using fertilizer, pesticides, as we discussed earlier, through drip irrigation, these things can be done. And DBT in fertilizer, rationalization of subsidies, spreading some jam in fertilizer area, these areas also we have covered. Credit access to farmers is again very important, because inputs are required for these things. Inputs require investment require credit, and credit require access. And access is of two types: physical access and economic access. Physical access is not provided if you don't have banks in the area, no bank accounts available to the person. Economic access, because his assets like his land might not be properly listed, so because of that he can't take credit. So there we are introducing things like national warehouse receipts and stuff which can be used to avail credit facility by the farmers. Now in horticulture, just some very brief figures for you. So you can see here that horticulture, which is the blue color, has been gradually increasing. So horticulture, there is a lot of scope for improvement there. We have to be pushing that further also. Now some extra facts from this chapter. Agriculture, again prelims, they love asking questions from agriculture. So some extra facts for you guys. India is the largest producer of milk. Just keep that in mind. We have the second highest population of undernourished people. 194.6 million people in the country are undernourished. That means almost 15% of the population of the country are undernourished. So to counter that, we have PDS, we have National Food Security, we have Integrated Child Development Scheme, we have Annapurna, we have Antodhya Anna Yojana. So all these things are being launched by the government. This was a big area of discussion, so questions can come on any of these schemes. So in your India Yearbook discussions, please focus on these schemes also. Now the government of India decides the minimum support prices, but it's decided based on CACP recommendations. So this is also something to be remembered. Since 2011, export of rice and wheat has been permitted. So sometimes we ban export of essential items, but rice and wheat is not under stress, so we have been permitting export. Export of cotton is now free and without any restrictions, another thing to remember. Now if you look at the overall world, 194.6 million or 15.2% malnourished, undernourished people in India. In the whole world, it is 794.6% or 11% of the whole world. India has not failed to achieve our Millennium Development Goals here. In Pakistan, again 22%, China only 9.3%. So we have not made much progress here. So just be familiar with these numbers as well. Now India again is one of the top 10 undernourished countries. In fact, we are the topper in undernourished countries. So second is China. So India is the topper. So again, dubious distinction, which means a bad thing to be famous for. Pakistan is third there. So India is not able to achieve our targets here. So again, these are all lot of highly discussed areas, so you should be familiar with these topics as well. So now we move on to chapter 6. But before that, again, we'll take a very short break. So we'll be back in like 2 to 3 minutes. Please stay tuned. Okay everyone, welcome back. We'll move into chapter 6 now. This chapter is about industry and infrastructure performance. So here economic survey analyzes and gives some suggestions, so we'll look at those aspects. So again, some key points for us from this chapter. Manufacturing growth is what is propping up industry growth. So industry growth has been low, but industry growth is not as low as it would have been because manufacturing growth has been okay, 5.9%, decent. So index of industrial production, which is a tracker of industrial growth, is coming out to be 3.1. So that is again okay, nothing great but okay, but inside that manufacturing is propping it up. So a lot of things are being done by government side, from government side also, to help it happen. So make in India, ease of doing business, things towards that, Startup India, Digital India, Smart Cities program, National E-Governance Plan, E-Biz portal. So all these aspects government is trying to do to help the manufacturing sector, to help the industrial sector. FDI limits in various areas are being raised so that more investment will come there. FIPB limit. So this is a Foreign Investment Promotion Board. So what happens is that there is an automatic route and an FIPB route for any investment or foreign investment coming into India. So automatic route, which goes through RBI directly, still has a limit. If it is more than 3000 crore, then it will again go to FIPB. So that limit has now been raised to 3000 crore. Earlier it was less than that, now that limit has been raised. So now until 3000 crore, as long as FDI limits in the sector permits, it can be automatic. Beyond 3000 crore, everything has to go through FIPB. The Ministry of Environment, Forest and Climate Change is now introducing online clearances, because clearances, as we saw earlier in the Chakraview chapter, is a big area where things get stuck. Things don't get clearance. Now they're doing online clearances so that things can happen in a much more transparent and faster manner. Labor market reforms having introduced, we saw that in the competitive federalism part of our discussion. In World Bank's, there's apostrophe here, sorry for that, they do a ease of doing business. They have an index for that. In that, India comes to 130th rank in the world. So that is actually an improvement. It might sound like a bad rank, 130th rank, but it's actually an improvement over previous years. So India has been improving in the ease of doing business ranking. Now the reason for this is primarily because electricity has become slightly easier to get in India. Now in sector wise also, economic survey goes into some detail. It picks up each sector. Steel, aluminium, one sector is picked up. There only read the highlighted lines. Nothing else is required. So wherever some potential question is possible, it has been highlighted and given to you in the highlighted PDF that is accompanying the lecture. The gross capital formation in industry as a whole has declined. Again, remember the trend, declining of gross capital formation. Very easy to remember because we know investment is coming down, right? So if investment is coming down, GCF is automatically coming down. 34.2% is the GCF which economic survey quotes. Credit growth has slowed in industry to 5.3%. So credit growth is coming down, which is also linked to investment. If credit growth is coming down, investment automatically comes down. These two guys are linked to each other. Now you have to see box 6.1, which goes into some detail about Make in India and the National Manufacturing Policy of 2011. Useful to just read through the box 1. All the important areas again are highlighted, and every box is provided in a separate PDF for you. Now in that, the important boxes PDF, only the important boxes are there. Whichever boxes are not important is not even included in that particular PDF. And in the boxes, there's always a higher potential of questions being asked. So that is one PDF I would request you to please go through. Box 6.2 talks about what all measures we are doing to improve our ease of doing business. So in gross capital formation, what you to understand is that production happens, right? Out of production, what happens? Income comes. Now income can be utilized in two ways. Can be either consumed or it can be saved. So whatever is left out after consumption of the original production becomes the savings. Now this savings can be done by either public sector or private sector. It can be done by either category of people. And even inside private sector, it could be households and firms. Now once the saving is done, then it can be invested. Whatever is consumed can't be invested again, but whatever part is saving can be invested, and that becomes gross capital formation, etc. So that means savings is an important component. So if you remember in our early lectures, we have talked about the savings investment linkage. Savings is what causes investment and hence capital formation, and then more production happens because of capital formation. So everywhere savings is an important component. So that ratio is important for us, but in general, gross capital formation, we have to be keeping on tracking it. So we can see there has been a decline of gross capital formation. So this is just a pictorial representation of same thing. Savings can be private and public, and inside private it can be household and companies, and inside household it can be financial and physical. How do you save physically? By investing in a house. How do you save financially? By putting money in the bank or investing in the stock exchange. So continuing chapter 6 again, some key points. Further key points, infra focus is crucial is what economic survey says. We have to focus on infrastructure because that is one big bottleneck for the entire economy. So National Infrastructure Investment Fund has been created, and they will provide support. So they will actually provide equity support for people investing in infrastructure. Now in electricity sector, DISCOMs, the distribution companies, Uday scheme has been launched. We have gone into great detail there. Credit growth in infrastructure was also slowed. So infra investment is coming down, and again credit growth is slowed. Here it has slowed down to 2.5%. Now to prop up the infrastructure area, National LED program, smart grid mission, various focused interventions in coal sector, these things are being done by the government. Then box 6.4, a full discussion about petroleum sector is there, which is important to understand. Let's just jump there and see the box once before coming back in. That comes in page 22 in your important boxes PDF. So if you see here, the global gas market is used to benchmark the domestic gas price in India. So there's a formula based approach towards gas prices. That there changes are being proposed, and that paragraph becomes very important. The cess that is being collected is being utilized for building gas pipelines, which is again useful. A viability gap funding concept is introduced by government. So wherever extra money is required, government will pump the money in there. LPG subsidy has to be rationalized. That is again crucial. And our import of LNG, liquefied natural gas, is exempt from customs duty. Whereas other uses of that is only for power industry. Whereas for anything else, if you import LNG, that causes customs duty. This kind of exemptions, which violates a one product one price rule, one product one price principle, has to be avoided. So these are some areas which it highlights. So again, important box. So some of these things can come as questions. So let's go back to a lecture again. So a lot of initiatives in renewable energy sector also has been highlighted in the economic survey, and those things again are important. So we'll see some solar mission, etc. That is also important. In railways also multiple initiatives has been taken, especially the high speed project. And for roads, there is a Bharat Mala scheme introduced. So again, for this we have to go back to a PDF and just go through it once. So if you see the PDF, let's see take the entire PDF. We are currently in chapter 6. So you can see here that all the important areas are underlined for you. So you can see steel industry separately underlined, etc. Whatever is important is highlighted there. So you can see here that the national LED program is very important, completely highlighted. So there's a street lighting national program, SLNP, very important. There's a domestic efficient lighting program, DELP, again very important for us. The national smart grid mission also, all these missions you have to be remembering and keeping. So SLNP and DELP. Both are very important schemes for us. So in the coal area, there's a Coal Mines Special Provisions Act which has been enabled. Auction of coal blocks is now becoming e-auction, which will again make it more transparent. So multiple things are being done in the coal area also, and there's even an interministerial task force that is set up. So all these things are important for us as well. However, the numbers etc. not important. Just remember these. Even the actual act also might not come as a question, but you should remember e-auction is happening. Those kind of details has to be kept in mind. So again, let's go back to our lecture. Now MSME or micro, small and medium enterprises is another important area. There also we are having multiple new schemes. So the full list of schemes will be highlighted in the economic survey itself. We have to go through that. Startup India again becomes important there. FDI, we have a much higher focus on FDI now. However, economic survey says 60% plus of our FDI is coming from Singapore and Mauritius. Why? Why are these small countries giving us so much FDI? This is because of a concept called round tripping. This is very important considering that just this week, recently we had more news about black money coming in. So whenever black money based issues comes up, these kind of concepts become important. Round tripping is that India is here, Mauritius is here. Black money goes from India to Mauritius and then comes back to India as white money. That is called round tripping. Money has taken a round and come. This is happening because we have a no double taxation agreement with Mauritius. So when money comes from Mauritius, we will not tax it again. Now, what investors do is that they look for countries which has nice favorable treaties. This is called treaty shopping, and then they will use that to invest back in India. So round tripping. This is the reason why Singapore, Mauritius, such tax havens are giving so much FDI to India. Now inside India, 70% of the FDI goes to Delhi, Haryana, Maharashtra, Karnataka, TN, Gujarat, AP. So these are our biggest priority or biggest FDI flow areas, out of which Delhi has the majority of FDI flow. So again, something to remember. So you can see here Singapore is the number one. Singapore becomes topper. Second is Mauritius. Third Netherlands. Then comes somebody like USA. One would have thought that USA etc. would be much bigger, but Singapore and Mauritius are the toppers. So no need to remember the numbers, but remember Singapore is bigger than Mauritius right now. There was a time when Mauritius was bigger, but now Singapore has overtaken Mauritius. If you look at industrial performance, 5.9% growth in the last year. Advanced estimate says that it could be as high as 7.3% in the next year. IIP is 3.1. Out of IIP, inside IIP, we have a concept called the Core 8 or the index of 8 core industries. Those 8 core industries do at only 1.9%. So the core industries are not growing fast enough, which includes coal, etc. So electricity, coal, fertilizer, cement, all these guys are there. Some of them had positive growth, whereas steel and aluminium had negative growth. So again, this is useful to remember which sectors had positive growth, which sectors had negative growth. Export of steel to India or import of steel by India has increased. India is the 4th largest producer of steel in the world, but still import to India has increased. Growth of credit, as we saw, has slowed down. Now MSME sector initiatives, as we discussed earlier, all of them are very important. We should be able to remember them. So we went to the PDF to look at them, but we have mentioned it here also. So we just go through with this itself. So the Udyog Aadhar Memorandum, UAM, very important. It is under the MSME Development Act of 2006. So this is the idea here is that with a very easy process, they will get a Udyog Aadhar number, UAN. So all MSME entrepreneurs will now have a Udyog Aadhar number. So Udyog Aadhar is the crucial part of it. So it's basically an identity number for the entrepreneurs, MSME entrepreneurs, and it's based on self-certification. no supporting documents required, etc. Employment exchanges we are promoting, so that what happens in employment exchange, suppose I am looking for a job, I go and list myself in an employment exchange. A company which is looking to hire people will also be listed there. So employment exchange will give the data of my data to the company, and the company, if they want, can hire me. It is very similar to a Naukri or a Monster, etc. So employment exchanges has also been launched since June 15, 2015. And this is specifically for industries. Now some MSMEs might be struggling. How do we revive and rehabilitate them? For that, we have a committee for distressed MSME enterprises, and we have a corrective action plan also coming for each unit. So that is what is being done for MSMEs under stress. We have something called Aspire, as mentioned earlier, a scheme for promoting innovation and rural entrepreneurs. Now it could have been scheme for promoting innovation and rural entrepreneurs, but then it will be called Spire. Aspire sounds better, so a scheme for promoting innovation and rural entrepreneurs. We like having nice acronyms. So the idea here is about technology centers, incubation centers, which will promote entrepreneurs in the rural areas. Rural startup promotion, just think like that. Aspire is about rural startups. Now if you look at FDI part of it, we have FDI easing in multiple areas. Broadcasting, the limit is going up. Investment in various areas. Single brand retail trading, 100% automatic route. Some sourcing norms are also involved there. Duty free shops, 100% automatic route. The next part of this, defense, again has been changed recently. The percentages have been increased 100%. Banking, again very high percentage allowed. Construction, 100%. Some conditions are involved there. Plantations, not allowed in some areas, 100% in some other areas. Civil aviations, again it's allowed. And limited liability partnerships, LLPs, again we have allowals happening there. So you should be familiar with in each area what percentage and what conditions. Those are areas from where questions can directly come. So if you look at primarily at Make in India only, so manufacturing cities have been envisaged where we'll have primarily manufacturing happening. A 25% target for manufacturing in the economy. That means of the entire economy, 25% of the GDP should come from manufacturing only. That is a big target. That's a target that has been set by Make in India. Currently, it is 15%. We want to make it 25%. Subsidies will be provided, and 25 growth sectors have been identified. So some numbers to remember. Again, no need to by heart anything. So if you look at the startup policy, this is just a node-based thing for you of what is the meaning of a startup. These things has to be ticked before you can classify something as a startup. So it has to be via DIPP. So some conditions are kept for the government to be supporting the entity. Now what are the areas where requirements are there? Funding requirements are there, registration requirements are there, and infrastructure requirements are there, and reducing corruption requirements are there. So if you really want to promote startup, you should be able to, first, one part of it is only funding. We always think startup is all about funding, getting money, but funding is not enough. We also have to reduce red tape here. We have to improve infrastructure here, and we have to reduce corruption also. Only then the startup can continue. The funding is only about the starting of the startup. For success of startup, we also need the ecosystem to improve. So Startup India also has to focus on these challenges as well. So India is ranked 3rd in the world in terms of startups. Some interesting numbers. So from 2010 to 2015, 18 billion had come, of which 9 billion, half of it came in 2015 alone. So a lot of funding coming into India, but that's again only one part of it. Other areas is still in need of improvement. So in funding, as far as funding is concerned, we don't have much of a problem. But then government has also set up a fund through which money can be given. Startup profits to be tax free for a few years. Self-certification based, compliance based, which means not much inspection, inspector Raj, etc. won't happen. A government app for startups. Public procurement will be done so that startups will have an established demand by the government itself. An easy exit for startups. And a fund for startups by the government. And a credit guarantee fund, which basically means if a startup takes credit, government will stand guarantee. Tax exemption on capital gains. So all these multiple things government is doing to promote startups. So again, some of these things you should be able to remember, even it can come as a mains question also. So some measures towards ease of doing business. This is coming directly from the box itself. So things have been made online. A lot of applications are now being processed online. eBiz portal for a lot of government services. So we are trying to limit the number of documents required. So documentations is being reduced. And even security clearances will be granted faster. So all clearances will be granted in a much faster manner. Sorry. So FDI sector, defense goods, all these areas again have been opened up, de-licensed, so it can be used faster. The Uday scheme we already saw in the previous lectures, but some numbers are being introduced here. You can see commercial losses are increasing continuously. So without subsidy, your commercial losses would have been very high. With subsidy, at least it's a bit lower. Whereas if you look at borrowings, it's been consistently increasing over time. So the discoms have been consistently increasing the borrowing, but they have not been able to get much profits. Now if you have continuously increased borrowing and not much profit, what will you have? You'll have increasing losses happening there. So borrowings have increased a lot, losses have increased a lot, so they are in requirement of being bailed out. That is where Uday comes, Ujjwal Assurance Discom Yojana. So it is optional for states, one thing. So what is going to happen is that the debt of the discoms, as we discussed earlier, will be taken up by the state government. 75% will be taken up by the state government, the rest will stay with the discoms itself. So 50% in the first year, 25% in the second year will be taken up by the state governments. So once this happens, the discoms will be reduced of or be devoid of much of the debt they had to, or the debt burden they had to bear until that point. Now how do the state governments do this? They can issue bonds in the market. All these options are available to them. And any future losses might also be taken. So it is not like it's a one-time thing. It can be done later as well. So some targets are also set under Uday. AT&C losses will be brought down to only 15%. That is one target, something to be remembered. Average cost and average tariff. The discrepancy between them has to be reduced, because as long as cost is more than price, you will continue to have loss. And as long as you have loss and you're not building up a profit, you'll continue to have debt burden. And as long as debt burden is continuing, government has to keep on pouring money into the sector. So this can't be a long term, it's not a sustainable model. So eventually the cost and the tariff has to be rationalized. So the tariff has to increase. So if you remember in the earlier lectures, we discussed how to increase tariff. How do we increase tariff? We can increase tariff by cross subsidization. What is the meaning of that? What we can do is we can increase the tariff for the rich. And how do we know who are rich? People who consume more tend to be the richer group. So increase tariff for higher bands, and at the lower level, when consumption is low, reduce the tariff and keep. And this allows for capturing the extra price, which will allow them to discoms to start generating a profit. So 12 states have so far signed up as far as economic survey is concerned. Now the worry for states is that it will increase their fiscal deficit. So 8.5% combined fiscal deficit, 4.8% for states. This is a worry for the states, that fiscal deficit will increase. The LED program is also been implemented. As we saw, DELP and SLNP are two parts of the LED program. domestic efficient lighting program, one part of it. So there are again some numbers. We want to replace the normal incandescent bulbs by LED bulbs because they are much more efficient, and this is the kind of energy savings we are expecting. The peak load will come down. Peak load means if everybody is using the energy requirement is very high, but if everybody is using more efficiently, energy requirement comes down, so peak load comes down, or even the consumers benefit because their bill will improve. Now domestic and street, right? Domestic is one part, street is one part. So domestic, if you do, it benefits the consumers. If street lighting, if you do, it benefits the country also. It also reduces greenhouse gas emissions. Now there's a roadmap for how much renewable power we want to create by 2022. Please remember it's 2022, not 2020. 175 gigawatt is a total target. So total is that much. Out of which we have some sub targets also. 100 gigawatts from solar, 60 gigawatt from wind, 5 gigawatt from small hydro projects, not the mega big hydro projects, 10 gigawatt from biomass. Now these numbers you have to by heart, because direct questions didn't come, because environmental questions are becoming slightly factual oriented also. So 100 gigawatt, how much is the solar target? You should be knowing these things, and it's also useful for writing mains exams. Now if you look at urban development, now this slide I'm not going to discuss separately and all. I've just given you some numbers here and some important areas there. So we have the urban project. Here it is about Amrut. It's about urban rejuvenation. So smart cities will get allocation and Amrut will get allocation. They'll be going parallelly. So how do we select smart cities? It is through a competition. How do we select Amrut? Any city over 1 lakh and above population will be classified under Amrut, will be eligible for Amrut or urban rejuvenation. Whereas smart city, it will be through a challenge or a competition. So Atal Mission for Rejuvenation and Urban Transformation, full name for Amrut. That kind of questions typically don't come, but this can be a potential question. So once a smart city is selected, it will start getting assistance, central assistance of 100 crore per year for the 5 years. So Amrut is essentially nothing but JNURM, which you keep seeing in buses, etc. You might be seeing JNURM, right? It's basically about urban renewal. So that has now been converted into Amrut. The name has almost changed. That's all. So whatever is not completed under JNURM will now be completed under Amrut. So some of the focus areas, again remember this: water supply, sewerage management, transport, green spaces, all these are focus areas for Amrut. Now urban development, one more terminology or one more scheme is called Hriday. Again, nice name, very stylish name. Heritage City Development and Augmentation Yojana. So how do we take it out of Hriday? Heritage City Development will come somewhere here. Augmentation will come in the A and Yojana is the Y. So Hriday. So if you remember only Hriday, you will not be able to get the full form of it. You will not remember. So please by heart the whole thing. Heritage City Development and Augmentation Yojana. It is under Ministry of Urban Development. Now this kind of questions also come. Among the following, which of the schemes are under Ministry of Urban Development? That kind of questions can also come. So 12 heritage sites are going to be developed. So I have listed out the, we have listed out the sites names here: Amritsar, Madura, Ajmer, Dwarka, Velankanni, Kanchipuram, Puri, Gaya, Varanasi, Warangal, Badami, Amravati. All these guys are there. Please remember this. A question can easily come among the following, which is not a heritage city to be developed under Hriday. They might give Madura, Dwaraka, Kanchipuram and Kolkata. So you might not be able to figure out which is a city unless you know the list. And all these areas are to be developed. So again, please remember the cities. So bullet trains has been in the news a lot. What you have to remember are these aspects of it. It is going to be Mumbai Ahmedabad project, the first project. So how big the number is need not be remembered, even though a lot of discussion happened on that, controversy happened on that. Japan is going to fund 81%. Please remember that. and the speed is going to be 300 to 350 kilometers. Please remember that. And the time is going to be cut from the current 8 hours to only 2 hours. So that is also important. The fare will only be 1.5 times AC fare. That we have to wait and see. We cannot trust that. So overall, a 505 kilometer corridor might further be extended. So some factual part about the bullet train discussion. So now we move on to chapter 7. Again, we'll take a very short break before we do that. So let's take a short break of 2 to 3 minutes. Welcome back, everyone. We're starting chapter 7 now, the services sector. So some key points for us. First is that the service sector is a key driver for the whole world also. 1/3 of the world's GDP is coming from service sector. However, in India's case, it's 2/3. Can you see the difference? For the world, it's only 1/3. But in India, service sector is so dominant, it is 2/3 of the economy. Foreign exchange earning from service sector is high. FDI is also high. It is in fact the maximum. It is 50%, more than 50% of total FDI that comes into India comes from service sector. And even the entire world's global FDI is actually 51% goes into service sector. So overall, service sector is very, very dominant in the world and very dominant in India. So there's a box 7.1 which is provided for you, which discusses WTO and service trade aspects. Now, post-crisis, service has slowed down. However, even though it remains highest to GDP, but service tax contribution to overall tax contributions are low. So, even though service contributes to GDP, tax and employment part, it is not able to help much. So these are two crucial aspects, right? Like we discussed, tax is very important and employment is very important. India under taxes, etc. we discussed, if you remember, and employment, if you remember, jobless growth concept is there. So these two aspects of service sector is a problem, but otherwise service sector is a dynamic, fast growing sector for India also. Lot of regional disparities. Delhi tops the state GDP in services, then comes Maharashtra, etc. Now inside services, tourism is an interesting and very important engine. So it allows service growth, it allows foreign exchange earning, a lot of employment is generated by it. So that way tourism is very important. In fact, 9.4%, almost 10% of the total employment in the entire country is generated by tourism. That is how important tourism is. So India's share in international tourist arrivals is only 0.7%. That means of the entire tourism that happens in the entire world in terms of tourist arrivals, only 0.7% of tourists come to India. So in spite of a lot of efforts by state governments and national government, tourism, we are not matching our potential. Being a culturally, environmentally, geographically so diverse a country, we should be generating much more tourism. Our foreign tourist arrivals has fallen and foreign exchange earnings have fallen. So in both areas, tourism, it has come down. We have started e-tourist visa or e-TV for 113 countries in 16 airports in the country. And even for visa fee, we have kept slabs now. Different slabs have been put for visa fees. Then we have started programs like Swadesh, Darshan, Prasad, etc., which we'll come back to. In shipping industry, which is also in the service sector, it is in stormy waters. That's like a phrase. In stormy waters means ship is in trouble type. So the Baltic Dry Index, which is a measure of shipping, is in an all-time, it's a very, very long time low for India. It's only at 290. In addition to shipping, we are also a ship breaking destination, which means we break the ships and take the scrap out, etc. So India is a leading destination for that, but there the cost is rising, environmental regulations are coming in, so that is also going to be a problem for us. Now one thing economic survey says is that coastal shipping, which is if India is like this, instead of transporting things like this, why don't we ship things like this? Instead of transporting from here to here like this, why don't we transport like this through shipping? And inland water transport. So if India is like this, we are here right now and we want to reach here. Why can't we go like this and then inland water transport? Or directly inland water transport. These kind of things has to be developed is what economic survey is saying. Other sectors are also discussed in the chapter. Real estate, internal trade, especially retail aspect, postal, all these things are discussed. And then in box 7.2 some suggestions are given. So we'll see some of those things. So most vibrant sector, as we discussed, in multiple areas. So International Labour Organization says even in job creation it is going to have a bigger and bigger impact soon. Most attractive field for inflow of FDI. Service sector is FDI in services is growing at 70%. And we are also doing a lot of FDI policy changes. A lot of caps have been removed. FIPB limit, as we saw, has been increased. So these things are being done. Service exports has increased over time. India's share of global exports and services is 3.2% and merchandise export is 1.7%. So again, useful to know. Service exports is growing at 4.1%, whereas last year it was 4%, so slight increase is happening. So service exports, post-crisis 7.5, we can see pre-crisis was 30.1. Imports was 23.6, 6.5. So post and pre-crisis, big differences happened. Now, here is where the government has to come in and promote things. So SEIS scheme, as we saw earlier, has been promoted under FTP. We have a global exhibition scheme where it's basically a conclave where people come down and export of various services are showcased around. Tourism and shipping, we are doing initiatives. Multiple initiatives have been taken. Medical tourism is another interesting and important aspect for India. So these are numbers we saw earlier. Tourist arrivals, tourist revenue in the entire world, we come here. Overall, it is decelerating. We are having a drop, especially from France, UK, Japan, etc. People are not coming as much. Our schemes include some of these things. Prasad, ETV, Swadeshi Darshan, etc. So let's look at the salient features of some of our important schemes. First is e-tourist visa. So it is to facilitate the ease of travel for them. So they can have a casual visit for 30 days very easily through an e-tourist visa. They can do it online, pay visa fee online, completely online. Or only a printout is required, nothing else is required. Very easy to avail. It can be availed only twice a year. More than twice a year it can't be availed. Only few airports have this facility because biometric authentication is required, so that has to be there on the airport. Now if you look at the Prasad cities, these are the Prasad cities, so same kind of questions can come in Prasad cities also. Which among the following has been classified as a Prasad city? So it could be 3 of these and something that is not here, and again you should be able to remember. So there's a lot of overlap between the earlier map we saw and this map, but here some other things are also coming in. Some suggestions given in the economic survey. The ETV window must be increased to 180 days. And if required, visa should be further extended to 60 days. Multiple point entry should be permitted. Right now it's single point entry scheme. Single point entry means if it's coming into the country, it has to be through one point only. Tourism infra has to be developed. CSR has to be channeled into tourism. Now tourism depends a lot on infrastructure. A nice tourist spot will be there, but if it's not maintained properly, people might not go. And their investment is required to maintain the infrastructure. And even the transportation, the roads, everything play a role in how much tourism happens. And SMEs can play a big role in tourism, so we have to keep promoting that. So in port infrastructure also can help, especially in the shipping part. And medical tourism has to be promoted under brand India. So we have Ayurveda, we have all these areas where medical tourism can happen, but we have to do it as a India brand instead of separately highlighting maybe Ayurveda, Unani, Siddha, all these areas. For medical tourists, they should be able to easily come, because medical tourists are also people who are very urgent in coming. They have a medical condition, that's why they're coming. So if we tell them ki your clearance will take 30 days, they will not come then. So it has to be very rapid immigration clearance. Now we come to chapter 8, which is about climate change and environment. So these questions might come in the environment part of your prelims. It might not come in your economy part. However, let us go through it anyway, because environment and economy gets combined together into one paper in the mains paper. But environment is a big chunk of questions for prelims. So some of those questions can come from in this particular chapter also. So Paris Agreement is very important. We'll see the highlights again. So overall global temperature should not increase more than 2 degrees. That is the limit that has been agreed upon by the countries. A bottom-up approach has been adopted, under which each country will decide. What is the difference between top-down and bottom-up approach? Top-down means top guy will decide and bottom guys will execute. Bottom-up means bottom guys will put their requirements and top guys you do it based on that. So here UNFCCC will take an overall target based on every country's commitments. So box 8.1 gives all the salient features of the Paris Agreement. Now a big focus of the entire summit is about how to finance all these things. It's easy to say we'll do 2 degrees limit, we'll do all these things, we'll do solar, we'll do wind, we'll do geothermal, etc. But where will the money come from? That climate finance, green finance is an important part. And where will technology come from? The developed countries have to give to developing countries that technology transfer. Now, even if the INDCs, the national commitments, even if they are met, even then the above target might not be met. That is the problem. So even if every country meets the target, the overall target might not be met. So that is something UNFCCC still has to work it out. Sustainable Development Goals is replacing the Millennium Development Goals. So Millennium Development Goals has been effective till this year. Now it is going to be replaced by Sustainable Development Goals. So 17 SDGs has been formulated. So India will have its own INDCs and domestic initiatives. Now if you look at historical or per capita terms, India is not a major contributor. If you just look at the world right now, we might see US, China, India as major greenhouse gas emitters. But historically, if you see cumulative emission, India is very low. Per capita emission, India is very low. So it is not fair to say that India should limit right now when other countries have developed after giving out so many greenhouse gases, etc. So this is called giving us a developmental space or carbon space. We need to also emit. So those countries have already developed by emitting, they should stop it now. Let India also emit and develop. So overall, at the global level, we should put targets, but at the country level, we should also take these considerations like historical per capita aspects into mind. Now, inside the overall emissions, fuel is the largest sector. So fuel is the biggest, or the energy sector is the biggest emitter. So this can be asked as a prelims question. Among the following sectors, or order the following sectors in terms of emissions. That kind of questions can come. Box 8.3 is important. You can refer to it. It's again highlighted. So individual targets are mentioned. That's also important. Some of the important schemes by the government, NIPCC. Basically action plans, national level action plan, state level action plan. Coal cess is being collected, 100 rupees per ton of coal cess is collected, and that goes to a national fund which will be used for sustainable development. So green finance is discussed in box 8.1, very important. So India has the NCEF again, which is the national level fund, and it operates on polluter pays principle, which means why is there coal cess? Coal is a polluting thing. Polluter pays principle means whoever is polluting has to pay to clean it up also. So National Clean Energy Fund has to be financed by polluter pays principle, or the polluters who are polluting the country, because cleaning it up will be financed by them only. So we have some of the largest global funds. We'll again be seeing them. Carbon trading is an important mechanism. So we have the clean development mechanism of Kyoto Protocol. We have energy certificates which are given out, and EU is one of the major trading centers and the major markets for carbon trading. So how does carbon trading work? What it means is that every country or every company will have a cap. Let's say 5 is the cap for every company. So this company actually wants to emit 10. That means it has to get another 5 from somewhere. Now this is 0. Now this company is actually not emitting, it's actually absorbing carbon. So it is doing good things. So it actually reduce carbon in the world by -5. So it gets 5 carbon credits. Now this guy wants to emit 5 more. So they can purchase from this guy and emit the extra 5. So what happens is that overall the limit is maintained, because only if somebody is absorbing carbon, somebody else can emit carbon. So this is one mechanism of clean development mechanism, or carbon emission or carbon market. So this figure shows that historically, or in terms of historical per capita, India is very small. China is very big, USA is very big, EU is very big. And in terms of per capita income and per capita carbon dioxide emissions, India is again at a very low level. Even China is low when it comes to that. USA is the highest emitter. So USA has to bring it down first. If you look at sectorally, you can see electricity and heat production is always the big chunk in any country. Other energies are all very small. Industries is another big chunk in a country like India, whereas in USA it has become smaller now. Transportation is always a big sector, but in India it's smaller. So like that, we should be able to know approximately what the big sectors are. However, electricity is the biggest sector. So these are the big funds. We have the GCF here and some of the smaller funds here. The Millennium Development Goals, these are the 8 Millennium Development Goals that were introduced earlier. They were supposed to be completed by last year, and it's over, 2015. Now, what they have done is they have implemented the SDG, Sustainable Development Goals. So here you can see poverty, education, gender equality, child mortality, maternal health, major diseases, environmental sustainability, and global partnership. Now, if you look at Sustainable Development Goals, it has now become 17. So what was 8 has now become 17. That's again important number to remember. So here we have much more different things. We have poverty, hunger, health, education, gender equality, water, clean energy, one extra thing coming in here, decent work, innovation, infrastructure, inequality reduction, sustainable cities, responsible consumption, climate action, life below water, life on land, peace, justice, partnerships. All these extra things are coming in Sustainable Development Goals. So it is recommended that you guys actually by heart the MDGs and the SDGs. Is very useful even for essay questions. So this is summary of the Paris Climate Agreement as a overall. 196 countries came together and adopted. There will be a finance part. Rich countries will provide minimum 100 billion towards it. Every 5 years they will revise their targets. and climate loss and damage will be tracked. The goal is 2 degrees Celsius, and if possible even 1.5 degrees Celsius. Forests will be given more and more prominence. 2020 onwards, this will become completely into force, and various clean technology developments has been promised. So all these aspects are there in the Paris Climate Agreement. So you can go into more detail by reading the highlighted parts of the PDF. So what is India's plan? India has certain commitments also. So we are going to reduce our emissions intensity. We are going to have more generation from renewables. 40% of our total power is supposed to come from renewables. These numbers are very important. Okay, direct questions can come. Additional carbon sink. What is a carbon sink? Some carbon is being stored into one area, typically forests. That is going to be created. And all this will cost us almost 2.5 trillion. So we need finance for that. So government is going to do a lot of things, which include some of these areas here: reduce emissions, develop proper infrastructure, etc. Other countries have put their own promises: 40% reduction by EU, 28% reduction by USA, 60 to 65 reduction by China, 28 by Australia. So some of these numbers are also useful to remember. So this is about ISA, International Solar Alliance. So what we are trying to do is that these guys get a lot of annual solar irradiation. So you can see as it becomes darker, more solar radiation. So India is actually having nice amount of solar irradiation. So we want to use that. So it is 120 nations between Tropic of Cancer and Tropic of Capricorn. Please remember this, because if you know your geography properly, this is where maximum irradiation happens. So that is the International Solar Alliance. The headquarters is going to be in Gurgaon or Gurugram. It will promote solar technologies, ensure solar light to households, and try to share expertise. So the India is part of this too. That is a big focus area. Again, the targets, please remember. Please by heart the targets. So now we move on to chapter 9. Again, we'll take another very short break. Okay guys, welcome back. Now we move on to the chapter 9, which is about social infrastructure. So we earlier talked about physical infrastructure. Now it's about social infrastructure, employment and human development. That is the name of this chapter. So some key points is: one, education has to improve. So again, quality of expenditure, if you remember. 3% of GDP goes into education expenditure. So of the total expenditure, of the total GDP, 3% of the GDP of the country is what goes to education expenditure. 2% goes to health expenditure, and both are stagnant. They're not improving over time. So that is bad. Enrollment in public schools is declining, which shows that quality is not there. Reading level of students are bad, which again shows that teaching is not happening properly. Teacher training is not happening properly also. So all aspects are turning out to be slightly bad in education. So there is a huge opportunity here to step up the investment, government investment, because as we remember, demographic dividend can only be captured by properly educated population. Health is another aspect. Only education is not enough. A healthy and educated person will be a productive person. So Janani Suraksha Yojana, Janani Shiksha Suraksha Yojana, both are required. And if you remember, early interventions are always good. If you remember from our earlier economic survey classific discussions, Mission Indradhanush has been launched for immunization. So multiple diseases are being attacked by Indradhanush. So there we are trying to focus on multi-drug resistance also, and even non-communicable disease we are trying to focus. So beyond immunizations. Swachh Bharat campaign also is supposed to help us here through sanitation, improving latrines, etc. Employability has to come. So education has to be there, health has to be there. Both these things we have to give. In addition to that, we have to have skill development also and make people employable. Only then can demographic dividend become a reality for us. 63.3% of our population is currently active population, economically active population, working age population. That's again a very important number. Please remember, 60% of our population is now economically active. Employment growth in organized sector is very low, only 2% is there. The labor force participation rate is only 52.5. That means only half the country is participating. Half the country who can participate is participating. And even there, rural is more than urban, which is again weird. Labor force participation rate means that of how the people who could be participating, how many are participating in the labor force. And for females, it is very low. So like we discussed in the discussion about how textiles are shifting to tier 2 cities and it will increase female LFPR. Female LFPR is low. We have to try to improve. In whole of South Asia, only Pakistan has higher female LFPR than India, and that's also becomes because Muslim fundamentalist nations don't allow females to work properly. So here we are trying different things like rural livelihood mission, MG Narega, all these things have been tried out. Now skill gaps are there. People don't have the skills that can be used. So there we are having NSDC, National Skill Qualification Framework, star rating, all these things are being done to improve the skills. Skill India movement. When it comes to poverty, we are using something called the Tendulkar methodology. According to that, poverty has declined to 21.9% in 2011-12. Highly controversial area. This number has to be by-hearted. Women work, right? Women also work. So imagine a situation under which the husband is working in the office, the woman is doing only housework. Is that work? It should be, right? Because something is being produced, food is being produced, domestic service is being produced. So somehow the GDP, the gross domestic production of the country, has to capture that also. That is the hidden contribution by women. That also has to be captured. How do we capture it? There is something called time use survey. So what they do is they conduct a survey of how time is being utilized, and if time is being utilized for work, we will classify that as work. So time use surveys is conducted. Again, economic survey goes into some discussion about that. Not very important for us. We have to just understand that women have a hidden contribution. They can be part of GDP and can be captured by TUSs, time use surveys. Now, there's something called Gender Development Index. India clocks in at 0.525, which is not a very good number in Gender Development Index. Now, our legal system is also failing the women of the country. The women of the country is not getting legal recourse. So, we have a lot of these dowry death cases. In dowry death cases, disposal of the cases happen after a very long period of time, and there are hardly any punishments happening. So it is still a patriarchal, male-dominated, male chauvinistic society which allows the woman to die purely for money. So these kind of issues are still there. So socially, culturally, we have to address it. But one good way of addressing is to make the woman independent, make them economically active, let them have their own income. Then they won't be so dependent on society or the family, and then they can start asserting themselves. So women education, women empowerment, women employment, all these areas are important for social infrastructure. Human development report is released. India ranks 130 out of 188 countries. We have an HDI of 0.609. Among all the BRICS nations, India is the lowest. So that's again a bad distinction for us. Now if you look at only at employment, the economically active population is increasing, so demographic dividend that is linked to that. Eventually start decreasing again. Organized sector is more. Annual growth rate of employment in private sector is 4.5%, which is again very bad. Whereas public sector hardly anything, 0.4% only. Total unemployment rate reported by Labour Bureau is 4.9%, which seems to be okay, but again please remember it includes the unorganized sector also. Now these are much higher than all India rates reported by the National Sample Survey Organization, which reports only 2.7%. So we have two numbers here. So depending on circumstances, you can use different numbers, but both of them are by government organizations, so we can accept both of them. So unemployment rates, if you look at NSSO survey 2011-12 and the unemployment and employment survey, in both cases the rates are different. So unemployment, there is no consensus on what we can actually use. In either case, we can see rural unemployment and urban unemployment. Urban is slightly higher. If you look at the organized sector, public sector is not growing much. Private sector also not much of a growth, and overall very little growth. So what do we do to counter the problem of unemployment? Different schemes have been launched. One is DDU-GKY, Deen Dayal Upadhyay Gramin Kaushalya Yojana. So this is basically a skill development placement oriented scheme primarily aimed at rural youth. So a skilling component of NRLM. There is NRLM, in that a skilling component. They will be given skill development, that is Deen Dayal Upadhyay Gramin Kaushalya Yojana. We have National Policy on Skill Development and Entrepreneurship, again aimed for large scale skill development. Then there is PMKVY, Pradhan Mantri Kaushal Vikas Yojana, very important. The aim is to get some 24 lakh Indian people properly skill based training, give them industry relevant training and get them employed. We have Payment of Bonus Amendment Act 2015. So as a point you can remember it, beyond that details are not really required. National Career Services Portal was launched by the government. Shram Suvidha portal is there. So a few portal names also. And Universal Account Number Facility, UAN, important for our EPF, Employee Provident Funds. If you remember, what used to happen is that people move from one job to another job, etc., and they lose the money in the previous account. If you have a Universal Account Number Portability and Facility, then they will not lose that money. So shifting jobs become easier. So the social infra part is required to achieve the demographic dividend, employability, skill development. Everything depends on first having social infrastructure. So education, health and proper housing are three things economic survey highlights. Now total expenditure on social service, including all these guys, was 7% of GDP. So there is a slight increase. It was only 6.5% in the last year. So in education, there is something called Annual Survey of Education Report, which comes out every year, ASER. Very important, remember ASER. So it says that the people in class 5 can't even read class 2 textbooks, and the amount of people who are able to read is keeping on falling. So education is not happening properly. Gender parity to some extent has been achieved, but higher education is not there. Primary education is compulsory, so we are able to achieve some level of gender parity there. Scholarships, we are introducing direct benefit transfer. So imagine JAM being given as scholarships. So we are introducing direct benefit transfer. So scholarships money will be directly getting credited to the parents or the students. So education sector continuing on 3% as we saw. TN, Tamil Nadu has a maximum expenditure on education in the 2013-14 year, for which we have proper data by now. This data always comes with a lag, okay? That's why we are having our 2013-14, 2014-15 data and stuff. So biggest challenges are how to increase enrollment, get more people in, but getting more people is not enough. We also have to provide them good education, so improve quality. Now improving quality also means improving quality of teachers, so improving quality of teachers, and finally gender parity. So get people in, give them good stuff, make sure good people are giving them good stuff, and make sure women, the girl child is also getting good stuff. So this is the challenges faced under education. So digital general address for advancing girls education has been launched, again focused on gender parity. Continuing to health, total expenditure on health as a percentage of total expenditure on social services 19.5%. The other percentage you already seen. Under 5 mortality has declined, it is now 49 in 2013. Immunization has been increasing, so above 80% now in some states, some other states 50% also. Rashtriya Bal Swasthya Karyakram, Rashtriya Kishore Swasthya Karyakram, etc. has been launched. So again, the schemes are important. Please read a few points about these schemes also if you get time. So proper immunization program is important, but problem happens because public health delivery, service delivery is always bad, and we don't even have skilled professionals delivering these services. So there, the trust in the public trust also gets compromised sometimes, because either delivery is not happening properly or the people delivering are not good enough sometimes. So some recommendations are put forward. So here, the recommendations part bring us back to volume 1 in a way. So overall, volume 1 and volume 2 goes together and then ties in together. So you can see the same concerns are being addressed here also. Investments has to improve, bank facilities has to improve, we have to be able to reduce subsidies, we have to be able to rationalize expenditure, we have to be able to deliver services in a better manner. So same concerns are there, but here in a more factual manner we have encountered all these things. So what the economic survey volume 2 finally recommends about some of these aspects is that delivery of services has to improve, it has to strengthen. For that, investment is required, and again, the moment investment comes, all the other discussion immediately comes into this. Imagine every other point pouring into this one point. And then improving service delivery, we can have technology helping us and innovative models helping us. So jam can again come in and help in delivering service delivery properly. So here we will be able to use database, we'll be able to use the mobile technology, and we'll be able to use the banking services to help deliver services in a better manner. And this is required if you want to go for inclusive growth, because educational outcomes, improved health, proper skill development, all these things are required for us to be able to attain a potential GDP. So if you remember, this is where our entire discussion started from, how to attain a potential GDP. India's potential is high, but there are so many areas we have gone wrong or can go wrong. So all those areas has to be addressed. So we have looked at all the areas to address, and we have looked at where India can possibly go, and that is what the overall economic survey has been about. Now in the next lecture, we will be discussing budget. So the budget is nothing but an implementation of the ideas of the economic survey. So budget will also be a highly factual discussion. So we'll be covering that in the next lecture. So next lecture is going to be geography and international relations through map. Slight change in schedule there. We will be bringing in geography and international relations through maps, which is again a very important topic. So many questions came in last year's prelims directly from our lecture on geography through maps and international relations through maps. So make sure you attend that. And after that, we'll be having a budget discussion. So again, the next 2 lectures are going to be geography through maps, then the budget discussion. So overall conceptual framework should be there with you now. So budget will again be a very easy discussion for us, even though it will also be factual in nature. So thank you for being part of the economic survey discussions. With this, we'll conclude our discussion. So all the best for all of you from Byju's classes. Goodbye. So we'll also have take a few questions now. So those of you who want to stay back for knowing the answers for your questions, we'll be addressing that now. So we'll discuss a few of the questions now. So one question that has come is, why is WPI negative and CPI positive? So think about it. We saw earlier that WPI, there is a big component for fuel in that, whereas in CPI we have a much smaller component for fuel. So when oil prices come down drastically, WPI as a overall falls down drastically. CPI does not fall as much. So CPI is also low because of oil, but WPI has become negative because oil has become really low. So that is why WPI is negative and CPI is not negative. Another question that has come is cooperative and competitive federalism. Cooperative federalism means center and state. More of center's money is now going towards states. So a lot of the work that center was doing, now states have to do. So center and state has to cooperate and develop things. Center and state has to work together in a lot of the sponsored schemes, etc. That is cooperative federalism. So this is mandated now because Finance Commission is saying states should take up more and more responsibility. So when you take up more money, you have to take up more responsibility also. Competitive federalism is between states. Now this state wants more investment, more employment, more companies, etc. This states also want. So both of them will try to create an environment which facilitates more investment. So they are now both competing to get investments from either from abroad or from inside the country, and this forces them to create business oriented or proper reduce red tape, infrastructure, etc. So any state which provides better business environment, better electricity, better transportation, etc. will get more investment, right? And also better education, etc. will get more investment. So states are competing with each other, and that is called competitive federalism. Another question, which is a very brief question, one person has asked from monetary policy, is marginal standing facility a quantitative tool? Yes, it is a quantitative tool. Anything which you use to control the money supply of the economy is a quantitative tool. So that is the answer for that question. I'm not going into details of what MSF, etc. is. Another question that has come is, how would currency depreciation affect the external commercial borrowings? So just take a very simple example. Let's say this is India's border. Okay, you have taken a loan of $10. Currently exchange rate is 50 rupees. What is the value in rupees? It becomes 500 rupees. Now later when you want to pay it back, if exchange rate is only 50 rupees, you can pay 500 rupees, it becomes $10. However, you have to pay $10 back. It is dollar denominated external commercial borrowing. Now suppose rupee depreciates and become 100 rupees. You still have to pay $10 only, but to pay $10 now you have to pay 1000 rupees. Because the value of rupee has come down. So earlier you were paying 500 rupees, now you are paying 1000 rupees. So the external commercial borrowing liability increases in rupee terms whenever the currency depreciates. That is the relation between currency and external commercial borrowing, and the exact inverse happens when the currency appreciates. Say 25 rupees if it becomes, then for the same $10 you have to only pay 50 rupees, so it becomes easier. Another question that has come is, why short-term debt is more dangerous than long-term debt, or is less preferred than long-term debt? Long-term debt, we have more time to pay it back, right? So we have more flexibility there. Short-term debt means we have immediately to have to pay it back. So short-term debt, if we have enough forex reserves, then we don't have to worry. In case we are not able to pay also, we can use from forex reserves and pay. Long-term debt, we always have enough time span is there. We can always find out other financing options and somehow pay off long-term debt. So long-term debt is less of a concern than short-term debt normally. So these are some of the major questions that have come up today. So you please feel free to send us any of your further questions. Now one student has also asked, how do I go about revising all these lectures? So we provided you all the revision notes also. You can use the revision notes for revising. In addition to that, all the videos are available on the platform, so you can download them or watch them as you please, and use that for revision as well. However, the advice is that use the notes plus the lectures. So don't depend only on the lectures, use the notes also. And if you want to revise very fast, use the notes itself. So that's how you should go about revising. And also you should be selective about your revision. So when you're revising, wherever the faculty is saying it's very, very important, please put more attention there. Other areas you can skip through faster also, because you already seen it. The ideas you have understood anyway, you'll just refresh in your mind. The facts and figures you might want to note down in a notebook. So if you have seen the economic survey notes, it's always provided in a note making format. On one side is the notes we are providing, the other half of the page is for you to make your own notes. So update the economic survey notes to the latest figures, etc., before you enter the exam, and make sure that you perform really good. So thanks for being part of the economic survey discussions. Again, all the best from everyone at Byju's classes. Thank you.